Hello everyone. Let me begin with the recent monetary policy decision where the RBI decided to maintain a status quo, which was pretty much in line with the entire market consensus, as also our view. But I think the critical thing over here was the underlying guidance that accompanied the statement, which to our mind is fairly accommodative in nature. And of course, it is data dependent. There is no two ways about it. But I think that gives us reasons to believe that the markets will continue to expect further rate cuts as long as the data, the incoming data, continues to be in line with what RBI anticipates. So fairly, markets were, I won't say very joyous, but fairly receptive to that. The yields came down. The 10-year benchmark, which was at 7.77%, currently is trading at about 7.7%. So a good easing of 7 basis points. We've maintained for long that the yield curve at the current juncture has discounted probably all the known negatives, including the impending US Fed rate hike, which is due later this month. We therefore believe that at 6.75 on the repo rate and at 7.7 on the 10-year government security benchmark, there is immense value to be explored through the fixed income route. What is the outlook going forward? We clearly believe, as maintained earlier, there could be a case for further easing, probably early part of 2016. The next monetary policy is on Feb 2nd. We at this juncture expect a status quo and probably the same accommodative tone to continue. And once we have better clarity on what US would want to do, we believe that there could be case for additional 25 to 50 basis point easing through 2016. What should be the strategies that one should focus on? I think there is no marks for guessing that strategies like the Kotak bond fund and the Kotak gilt fund, which continue to play long interest rates or the long duration bias, actively managed strategies would continue to find favor with investors to our mind. There is also a strategy, Kotak Low Duration Fund, where you get probably a mix of marginal duration and moderate credit with yields quite significantly higher than what money market funds are offering. These are the potent categories we believe that one should invest with at least 12 to 18 month investment horizons. The final say would be the only question that is doing rounds in bond markets is the Kona question, as I call it. When will bond yields come down? Our view is stay patient, stay invested. We believe the potential rewards could be beneficial. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.